you can give us 2-3 examples of each of these, each of these things, like value with triggers. Tell me 2 or 3 instances how you spotted these triggers.
Let's say 15 years back, 20 years back, there was some information arbitrage which used to be available.
Right.
And you used to get more time to analyze stuff. It was less noisy.
Right.
Now it's more noisy. There is no information is very, very democratic now.
Correct.
So you really have to try and be ahead of the curve in terms of identifying where those value opportunities are or where those re-rating opportunities are, and you will go wrong in some of those. So when you look at value with triggers, here the starting point is that the stock or the sector or the company has to be available at lower than 10-year average, or at least median or lower than median. That becomes the starting point.
In terms of valuation, in terms of earnings multiple.
Whatever the valuation might be, P, EV, EBITDA, price to book,
right.
Whatever that parameter might be for that sector.
Right.
Now, once you get that, then you try and question yourself, and the analyst question, or the analyst is made to question whether in the next 12 to 18 months, we are not giving 4 or 5 years here, whether in the next 12 to 18 months, are there any visible catalyst triggers, company specific or sector specific, which can lead to a re-rating.
Right.
So one example clearly I can think of is power utilities in 2022-23. Historically lower valuations. The main power utilities, and some going back even 2021. I think the renewable wave was just beginning then.
Right.
So there was a lot of question marks on whether fossil fuel based
will continue
utilities
or not.
will continue. Yeah. So there's no terminal value. Oh my God, the terminal value is 0.
Yeah.
So why should these companies trade at more than 8p, 7p, 5p? Why not 4p? I mean,
correct.
There is no limit to think negatively. But I think what was very clear at that point of time is that renewable is not the solution. It cannot be the solution for peak power demand, and fossil fuels will stay. But obviously there is very few believers there, which is why you're getting those stocks at those valuations. So there was a little bit of a structural call on the sector which had to be taken, and those stocks had to be bought. It's a different matter that things played out even better for some of those companies because they also got into renewable, and the power demand went up, if you remember, in fiscal 24. So there was a shortage, and therefore there was a wave of capacity announcements on coal-based, which kind of led to more people to believe what we believed, or what at least some other people in the market believed, and that led to the re-rating from, say, less than 1 time book to 2 times book, from PE of less than 10 times.
And the conversation around thermal itself changed because
completely.
At that time, even NTPC had said that they're not going to invest any more in thermal capacities
completely.
Or coal-based. So
many companies had said that, and they all took, made a U-turn.
Correct.
Because ultimately, I think everyone was thinking that power demand will also not grow in India.
Right.
But it certainly grew.
Right.
Last year has been slow, but again, what if it grows again at 5-10%?
Right.
If the GDP grows at 7%, and if we are talking about so much of urbanization and demand for ACs, I think it's going to grow. And if it grows at 6-7%, we'll again be scampering for power. And I think that I think was the re-rating for not just the utilities, but it led to re-rating of the capital goods companies, then it led to the transmission, and of course renewable wave was going on. It's not that one led to the downfall of the other. So it was a good kind of a structural call. Similarly, if you look at, I would say, relative value call would be probably healthcare, where I think we had seen a lot of competition coming in diagnostics in 2018-19. A lot of online discounting happened, especially during COVID. And relative to their own history, they were cheap. But we could see that there is a stress, there is a funding winter which is going to come on after 2021 burst. And that led to, competition rationalization.
Right.
And that has led to, not a huge growth bounce back, but, believe that this is a secular growth story, and the valuations have bounced back. So not a huge earnings upgrade, but a valuation upgrade. That is what happens when in some of these cases. If you look at earning upgrade cycle, this is slightly different, which is what happened in banks in 2019, for example, because we were coming after a deep cycle of downgrades,
Right.
where write-offs and bad news after bad news kept on coming. And in 2019, I think all that, it was becoming clear that that is ending and you are going to enter into a benign credit cycle. Of course, nobody predicted that the benign credit cycle would be so sharp, but it was clear that it will be benign. So that was a call one had to take on banking, that the earning upgrades will happen. But sometimes what happens in earning upgrades is you start by taking a view that the earning upgrades will be small. But then you get surprised on certain factors which you counted on, which is, NIMs went up simultaneously, credit growth went up simultaneously,
Right.
and the provisions came down.
Right.
It was a trio of, good news, which I don't think we also anticipated in 2019. We just took a call that at least the credit cycle or the provisioning will come down. At
Right.
least one of the three is going in your favor,
Right.
and the remaining two are bonus.
Right.
And then the valuation is at a level where you are, so it becomes very, very easy. In 2025, I think the same thing is repeating, but in a very small way in banks, because I think everyone had assumed that NIMs will decline for
Right.
next 1 year. Now banks are saying that second quarter will be the bottom in NIMs. So obviously the rate transmission on the deposit side has surprised, which everyone was not assuming. So that is something which is also partially playing out.
Right.
What played out in 2019 in credit cost is going to play out in NIMs in 2025. And then, if credit cost surprise, if credit growth picks up, which is a big question mark right now, because that is one thing missing,
Right.
then you have a good combination of, re-rating kind of potential for the sector.